to SB Talks. Today is Wednesday, November 22nd, and I am joined, as always, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
We're going to start with the US equity markets if we can this week. The rally in US equities continues with the S&P 500 now up over 10% since late October, Nick. What's driving this?
It's really all about bond yields. We've seen a round trip, really, in bond yields. We've spoken about on previous calls how we've seen a steepening in the yield curve, and the 10-year yield went from about 4.5%, close to 5% during October, and then since mid-October it's reversed that completely. So we're now back down to about 4.4%.
Cue a market rally there in terms of excitement about the rate rises are done.
It's that the rate rises are probably done. So since then, we've had another Fed meeting where they've kept rates on hold, and we got the Fed minutes for that meeting yesterday, which basically said cautiously optimistic that inflation is coming down. They're still hawkish. They're still happy to lift rates if they see a lack of progress towards their inflation target. So that was encouraging.
The Fed are doing a delicate balance at the minute of sort of seeing what they want to see, but they're worried that everyone gets overexcited by the improving situation in terms of the rate outlook. So they're sort of, I think, cautiously optimistic, but not wanting to give everyone too much.
Yeah, well, that's right. The other thing that they had said, which is interesting, is that they had said that rise in bond yields was doing some of the work for them. Now, I just mentioned that that's all been reversed. So that's an interesting dilemma for them. But since that meeting, we've had the CPI report for October, which was pretty good actually. So the monthly core inflation reading rose just 0.2%. That was below the 0.3 expected. And under the surface, there was some good progress on things like shelter inflation, services inflation more broadly. So I think there was some degree of confidence taken by the market that inflation is tracking lower.
That the interest rate increases that we've had are having the desired impact.
Yeah, well, that's right. It's not just about interest rates. I think there's also some rebalancing in that labour market going on. So the unemployment rate's ticked up a little bit. The number of jobs created slowed a little bit. So all the signs are good, but maybe 1 or 2 months of good data doesn't necessarily make a trend. And I think, as the Fed said, if there are signs that progress isn't being made, they won't hesitate to raise rates again.
So cautiously optimistic on that front, but certainly that's enough for the equity markets to have a bit of a pre-Christmas Santa rally there. Reporting season, we've talked about it a couple of times on the podcast here. Any other wraps that you would have? Anything else caught your attention?
No, well, that's another reason why equities have done well, is reporting season was good. We've spoken about that previously. Overnight, we got NVIDIA, obviously one of the Magnificent Seven, reported
been the absolute centre of hype this year with the AI revolution, and their chips been at the centre of it.
Yeah, I mean, and another very strong result. So the quarterly revenue came in $2 billion ahead of expectations. So they printed 18.2, I think, billion versus 16 expected. Right. They guided for revenue to be 20 in the December quarter. That's $2 billion more than markets had forecast. So it's very strong demand for their AI chips and their data center chips. So yeah, so it continues to be a pretty good story there. Yeah,
we've talked about how the analysts have looked for these sort of broad areas of signs of how different companies are successfully managing to adopt AI or roll it out, and we've seen broad measures like the adoption of cloud computing. I think NVIDIA is the most obvious, simple point of where you can see straight through demand line, because their chips, their cards are being used to essentially drive a lot of this activity at a whole variety of different organizations and geographic points. So yeah, I guess it gives increased probably weight to the enthusiasm, or at least gives substance to the enthusiasm that's there. There's definitely a genuine demand there, and then it's not appearing to be a short-lived thing.
No, absolutely not. I mean, this all kicked off with NVIDIA I think back in the March quarter, showing just how strong that was, and it got a big pop then, and has really been able to maintain a lot of that demand momentum.
Okay, we'll continue to watch this space, see how the Magnificent Seven ride into 2024, and perhaps that's something that you'll be talking about as you begin to look into the new year in your end of year report. Locally, slightly different picture. So the US had gone harder on rates earlier. Australia was still been playing a little bit of catch up. We saw a rate rise as recently as this month. And our share market, perhaps not surprisingly, has been a little bit more subdued, whereas the US market's up over 10% since late October. We're up probably about 4.5% over the equivalent period. And So a lot of eyes and ears on what we hear from new Governor Michelle Bullock, and it's a topic we've discussed here before, but she's been cautioning again on the rate of wage increases, and it's not sustainable with what we're seeing in terms of productivity gains or lack of productivity gains.
Yeah, so productivity's fallen 3.6% in the last year and is basically back to where it was in 2019, whereas US productivity growth has increased over that period. So it's a bit of a quandary. She says that 4% wage growth, which is what we're currently at, ordinarily would be consistent with inflation being within their target range of 2 to 3% if you had productivity growth of 1 to 1.5%, which is kind of the long run average. But when productivity growth is going backwards, the unit labour cost, as they call it, which is the true cost to companies, is the 4% plus the 3.6% contraction in productivity. So it's actually costing them 7.5% from a labour cost perspective. So she says they need to pass that on to end consumers. That's inflationary.
Yeah.
So that's what she worries about. Now, people are concerned, why is productivity so weak?
We've talked about this before. It's quite a difficult area to measure, sort of like blunt instrument measures, but it is definitely a concern, the trend we're seeing.
Yeah. Is it work from home? Is it that we've brought in all these migrants and there's a skills mismatch? They're not properly trained for the jobs and they're just not as productive? Or is it the measurement issue? It's probably a combination of all three, but it's certainly something that the RBA is concerned about.
Particularly if you're looking at other parts of the world where they are making those gains, and you expect technology can bring productivity gains, and we're certainly not seeing it.
Yeah. So that was one of the things that she highlighted. I mean, I think the other thing that she's been talking about is, the strong population growth has clouded the picture a little bit for the RBA. So their forecasts are a bit unsure because on the one hand, more people means more workers, which should put pressure on wages to bring them down as you get better balance in the labour market. But on the other hand, they add to demand in the economy. So the RBA's published some new forecasts where they're showing growth is going to be stronger than they'd originally thought 3 months ago, and inflation will track higher. So the minutes from the RBA board meeting and the commentary from Michelle Bullock yesterday was probably a bit hawkish, actually. It probably still leaves the door open for maybe one more rate hike, possibly two, depending on how inflation tracks kind of early next year. They're very concerned that they just won't get inflation back into their target range within an acceptable period of time. So there are risks around
and
that.
Remind us that their current forecast had those inflation coming back, was it late 25?
So they have it coming down to 3% in June 2025 and 2.9% in December 2025. So just in the top end of their target range. And recall the mandate for the RBA is for them to actually target 2.5%. So that's their target. It's not 2 to 3, it's 2.5 is the more explicit target for the RBA. So they'll still be above that in 2 years' time.
Albeit probably unlikely to pull the trigger on a rate rise in December. They're probably going to want to take a couple of months just to look at the data, and particularly with that key spending season there.
Yeah, so we'll get another quarterly CPI print at the end of January. So depending on where that comes, we'll either get a rate rise in February or March. So some banks are saying February and some are March, and some are saying no, they're done. So there's not a lot priced. There's only like a 50% chance of another rate rise priced by March at the moment.
Yeah, okay, watch this space. You've talked a bit before on the podcast and written in your monthly reports about the resilience in the Australian property market. Despite the rate increases that we've seen, the spring property market frenzy is alive?
Yeah, volumes have picked up. So the number of properties on the market is 31% above where it was this time a year ago. So that's sort of helped the market a little bit in terms of just bringing things into better balance. But despite that, property prices rose again in October, up 0.9%. It was after a 0.7% rise in September, so accelerating prices. And if you look across the different markets, Brisbane, Adelaide and Perth are now at new record highs, their property markets, and Sydney and Melbourne are just a couple of percent behind their April 2022 record highs. So it's still fairly resilient. Obviously, we had the Cup Day rate hike, and that will take time to flow through. So that maybe that will have an impact, as will potentially the increase in supply. But at the moment, it looks just very resilient. And it's interesting, like, for example, in the rental market, capital city vacancy rates at a record low, 0.9%. There's just not a lot of stock around. The population's growing 600,000.
Stands to reason with the immigration that you had, it's going to put a strain on the supply.
Yeah, and we're not building enough houses. I think the run rate's around 170,000 at the moment versus 600,000 population growth. So just not enough places being built. And so you can see why there's demand for properties at auction and also for rentals.
Very good. Now, talking on the same topic, property, but moving slightly further afield, the Chinese property sector has been the cause of much concern and sort of been the center point of just a general negativity towards China. We've seen announcements in recent days that the government's essentially named a list of 50 firms, let's call it potentially too big to fail, that are going to see special support from the finance sector in terms of making sure that they do not suffer more in this current crisis.
Yeah, it's this so-called whitelist of 50 public and state-owned developers that are eligible for funding from banks. We've seen these sort of measures before. There was another whitelist in December last year. I think it had a dozen property developers on that, including Country Garden, which has subsequently got into trouble. I'm not sure that these are sort of piecemeal measures. I don't really think that'll have much impact. I mean, the banks will still be cautious. They don't want to end up with problem loans. So notwithstanding the central government directive, it's not really a guarantee of these developers. It's just an encouragement to the banks to lend to them equally and treat them fairly, I suppose. But the problem is the government's trying to keep prices stable. So it's basically told everyone you can't discount properties. They have to be kept at this level. And so, of course, when you try and control price, demand falls dramatically. So you can't control everything. You
end with an excess supply.
That's right. Yeah. So,
and they're worried about the wealth effect of people that are owning properties already and seeing, the potential negative revaluation on those and the implications for the economy or civil unrest even.
Well, that's right. And so there's been reports of some developers secretly discounting and then getting into trouble for like giving incentives or sort of doing secret discounts to try and move stock, and they've got into trouble. So it's a real problem, and I don't think this whitelist will do much to help it.
On that situation rumbles, and we'll keep a close eye on it. Anything else on your radar this week? Obviously a quiet one with the US Thanksgiving holiday, and very happy Thanksgiving to all our US listeners, of which I'm sure there are maybe a couple.
Yeah, no, it's a fairly quiet week. As I said, we had the Fed minutes, the RBA minutes. There's not a lot of data around. I think things are quietening down a little bit. But yeah.
Watch this space. We will speak with you all again over the next couple of weeks, certainly between here and the end of the year. But for now, thank you for listening and take care.
Take care.